Welcome to Investors Guide. You're watching ET now. Thank you so much for tuning in. I know when you watch the market right now, it sort of makes you nervous. It would make any investor nervous, the kind of volatility we are witnessing in our markets right now. On the show this week, we're going to talk about what your strategy should be, especially in a market like this one, and how you should simply focus on your long-term goals and not get nervous at all. We'll tell you how you should be doing that as well. Remember, there's an email ID at the bottom of your screen. Send in any question you might have about your money. We'll start off by helping an investor save for his retirement and find out exactly how many insurance policies should one investor really have. In our product review, we look at the HDFC Long Term Advantage Fund, and we'll tell you how to maximize the tax benefits on your joint home loan. Right, it's time for me to bring in Narendra Kumar. Narendra, thank you so much for joining us. And I know that I do this every week where I ask you about the stock market. But unfortunately, given the market we're seeing right now, the best way to address most of the questions our viewers have is to just bring up one question right on top. And, you know, we went from seeing a drastic cut to last Friday rising really quickly. This week has been, if anything, really volatile. Down one day, up the next, down one day again. In a market like this one, should there be any change in our strategy of just simply doing an SIP? Because there's always that odd temptation to sort of pick up a little bit of extra stock or invest money on a day when the market is down. Should we attempt to do things like that?
It is very easy to be on a methodical plan and benefit from this because averaging will work beautifully. And it is extremely difficult, not only difficult, I would say that it is impossible for investors to predict these events. There are just too many moving parts. You know, something happens in the US, the interest rate changes, there will be an impact, there could be a lingering impact, there could be lasting impact, there could be a short-term impact. And it's very difficult to, estimate the scale of it, the timeline of it. Even if you have lump sum investment, you should average it. If you are, saving out of your income and investing on a regular plan, nothing like it. So it is very important for investors to resist the temptation to profit from such a move, either by investing or pulling your money out, because I don't think one can sanely do that. So just if you are onto a plan, stick to your plan. If you don't have one, make one.
Right, if you don't have a plan, it's time to make a plan, and that's what we'll help you do. So quick recap, continue to just invest through SIPs, invest in a regular manner, use diversified equity funds that invest right across the market. And you have no business being in equity if you don't have a 5-year horizon. And if you're looking at the long-term picture, then a week like this one shouldn't really bother you. It's time now to look at our portfolio, and let's just help one viewer, Narendra, who has a question for us on how to make a plan. 43-year-old Anil Kumar Singh has written in, and he tells us he wants to put money aside for his own retirement, for his child's education, which will be needed in about 11 years, he tells us. He has a home loan, he has an NPS account, and he has a couple of term covers and a Mediclaim policy and 4 mutual funds. But that's not the reason why I'm taking up this question, Narendra. He has 5 different ULIP policies. And he's putting about 1.5 lakh rupees into these ULIP policies on an annual basis. 1 from LIC, 1 from HDFC, 2 from ICICI, 1 from SBI, 1 from XI, 1 from HDFC, and 1 from Bajaj Alliance. It looks like he's covered the entire industry there. And this is also, I would believe, a classic case of mis-selling, because there's no reason at all why any one investor would need to have so many insurance policies.
Anil Singh has no plan, and all kind of, insurance salesmen have capitalized on that opportunity. I don't think he has been missold. Even if he has been sold, he has taken it, and I think it is his responsibility that he should worry about what is happening to his money, to what end. And first and foremost, he must have a plan. He must, he must develop a plan that how much he is able to save, where that money should go, how much insurance he needs, and how much health cover, and beyond that, what is his long-term, saving? What is the investment which he can make for the long term, the money which he is unlikely to need for next 5 years, and that is the money which should find its way methodically into a mutual fund, not into all these unit-linked insurance plan. And I think before that, all he requires is, clean up his policy, plan, make a plan, plan his exit plan with all these ULIP policies, and move all that money into a mutual fund. And for the first 1.5 lakh, if he is actually, making that investment, first 1.5 lakh rupee must go into a tax saving fund so that he is able to fully leverage the ATC benefit that he gets on his investments.
All right, so Anil, unfortunately, you don't have a plan, but we have a plan for you. You seem to be fine on your NPS, you're fine on your term cover and your health insurance. So that's great. That's an excellent start. We're unhappy with the number of ULIPs you have in your portfolio. It does seem like a lot of various insurance agents have sold you policies over the years, and I can see from the track record you've started investing in 2006 and you've been buying a different policy every year since. Now, this is what you need to do. You have to take a look at each and every one of these policies and exit them all one by one as they finish their lock-in of 3 years that you have to pay that money for. Start pulling your money out and wait until you can maximize that surrender value so you get the most money out of that policy. Once you do that, invest in a tax-saving mutual fund, the same fund every year, year on year, to save on tax, because it does seem to us like that's what you've been doing by picking a different ULIP every year. Now, what I'm going to do is on your screen right now is a list of tax-saving funds that we've recommended for this year, so you can pick one of those funds and you can add it to your portfolio. So that takes care of insurance, ULIPs and tax saving. Then let's take a look at the mutual funds he has right now. He has the DSP BlackRock Small and Mid Cap Regular, the ICICI Prudential Value Discovery, SBI Mutual Fund, a close-ended fund, the Dual Advantage, and the iPru Close-Ended Multiple Yield Fund. Now, I dare say he doesn't have a plan as far as his mutual funds are concerned either. And considering his first goal, which is his child's education, is 11 years away, his own retirement might be closer to about 18 years away, would you like him to just use one of our portfolios instead?
Yes, absolutely. First and foremost, he can just retain one or two of the open-end funds, and remaining, the other two closed-end funds, he has to plan. He can exit them only when they are, he can't take his money out before the maturity date or the redemption date. So he has to wait for that. But I think all the money which he'll be, saving by discontinuing his ULIP policy, that should start moving into either the growth portfolio or the aggressive growth portfolio. One good thing on his side is that he still has quite some time for his first long-term goal.
All right, so our growth portfolio is on your screen right now. And remember, if you have any more questions, if you're watching at home and you'd like us to take a look at your portfolio, and we'll tell you the truth, feel free to write to us. Our email ID is at the bottom of your screen. Narendra, I want to quickly ask you this question. Anup has written in. He wants to save for his daughter's education and her wedding over the next 10 to 15 years. He wants a couple of good funds to use. So basically, equity allocation over the long term. What should he be using? And for all the parents who are watching right now, who possibly fall into that trap of buying child plans or ULIPs that have child written in them, if they can just use one mutual fund or two mutual funds, Narendra, what would you recommend?
No, for this longer time frame, I would suggest that consider funds from our, maybe if you can build a portfolio, consider our aggressive growth fund, or the diversified fund from our aggressive growth fund will just do as well.
All right, so our aggressive growth portfolio is on your screen right now. If you just want to pick the diversified equity funds, you can do that as well. And if you want to write back to us, do that also. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. It's time for our product review, and this week we're looking at the HDFC Long Term Advantage Fund. Avan is here to give us a quick introduction. Avan.
Thanks, Faye. Under the scanner this week is the HDFC Long Term Advantage Fund. The fund was launched in January 2001 as HDFC Tax Plan 2000. It's one of the top performers in the ELSS category across several time periods and ranks 10 in its category over a 10-year period. The fund manager pursues the value style of investing, where he selects well-managed companies that are trading at a discount to their fair value and remains invested in such companies till the time they attain their fair value. This strategy has worked out well for the fund, which has delivered 24% returns since its launch. However, the recent performance has been below par when compared to its peers. Last year, the fund gave a return of 22%, while the category average is 35%. So is this recent underperformance a reason to sell this fund? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for that information. The HDFC Long Term Advantage, it's a tax-saving mutual fund. Now, It somehow has been chasing the category average over the last few years. It hasn't really been able to catch up. Within HDFC, there's a smarter option. Within the market in general, there are plenty of smarter options. Would you recommend investors give up on this fund right now and use, better options as far as tax saving are concerned?
Yes, there are certainly, better options. And this fund does extremely well when the market struggles. So, if you look at this fund, in 2008 or even 2013, as recent as 2013, this fund used to be a blockbuster, and that is no great news for investors. Of course, it's very important for a fund to do that way. That in a struggling market, you are able to hold yourself much better than most other funds. But investors don't invest in equity to lose less. And on the other side, when last year this fund did beat its benchmark, of course, this fund, I would say that, despite all the ups and downs and relative underperformance compared to most other tax-saving equity fund, this fund has mostly beaten its benchmark, except, 8-9 years back when it was 1 or 2 years when it was unable to. And the years in which it was unable to were the roaring years of equity market, something like 2006 and 2007. When it was not able to. So it's a conservative fund, and it has been paying price for that and holds ground much better. But looking at tax-saving universe, I think, investors have plenty of, I would say some great funds, and many impressive funds have come in recent years. So investors have far superior options to choose from. Despite this fund beating its benchmark, it may not be a great choice. If I have to list 5-6 funds, this fund won't figure there.
In fact, I'm going to run that list again. This is the list of tax-saving funds for the year that we've recommended on Investors Guide. This fund doesn't figure in that list either. Just purely on performance, it also loses out. If I were to ask you to give it a star rating for Investors Guide and your recommendation on what investors should do with this fund right now, what would you recommend?
I would assign it a very average rating, something like a 3-star, and that is where it stands. That is where it stands even on a risk-adjusted scale. Because there are two things. One is that when I lock in my money for 3 years, I am expecting that the fund manager will reward me for the compromise on liquidity, which is enforced on me as an investor. And why I would still give it an average rating despite its relative underperformance, simply because this fund has never compromised on liquidity and stacks up very well in a bad market. So maybe for some investor, for some very conservative investor, it might still have a case, or it can make a turnaround. But from your options to choose from, it may not qualify.
All right, 3 stars there for the HDFC Long Term Advantage Fund on Investors Guide. Narendra, they're telling us that it doesn't really qualify if you're looking for an investment right now. There are smarter options in the market for you, especially if you're looking for tax saving for this year, 15-16. We have a list and you can write to us and someone will email that list to you as well. Let's move on now to our hold or sell segment. Rupali Rastogi has written in, Narendra, she's 35 years old and she's been investing 16,000 rupees in mutual funds every month. Now she tells us her aim is to build long-term growth and, long-term returns. And she wants to know if her portfolio is on track. Right on top is the Birla Long Term Advantage Growth Fund, 5,000 rupees every month. Continue that investment?
No, this is a fund which, worth discontinuing. I don't know why it happens to be a choice. It's a fairly average fund. And and among the diverse the universe of large and mid cap fund or the multi cap funds, there are far superior options to choose from, including from Birla itself, which is the Birla Sun Life Frontline Equity, which figures as in many of our portfolios as well. So this is a fund which is an average fund, nothing alarming, but you have far superior options to choose from, so you should move your money.
All right, move your money. In fact, you'll find the next 2 funds very interesting, Narendra. She has the Franklin India High Growth Companies Fund and the Franklin India Smaller Companies Fund. Now, they've both been interesting performers, and it's obvious that whoever's selling her mutual funds is looking for concepts and themes and ideas and selling her funds based on various ideas. Would you recommend she holds on to both of these funds and continues her investment, 3,000 rupees every month into each of them?
For sake of simplicity and choosing one of the 2 funds, I will go with Franklin India High Growth Companies Fund.
Canara Robeco Emerging Equities Regular Growth, Narendra. Again, a name we don't often hear in portfolios. She puts 2,000 rupees every month in this fund. Should she continue that investment as well?
Yes, this is a very impressive fund. In fact, it is among the most impressive mid-cap fund. And as she's putting just 2,000 rupees here, it's just the kind of allocation one should be having. It should not be a substantial part of your portfolio, and it's a very impressive fund. You need to review all these investments every 2-3 years.
She also has a couple of one-time lump sum investments, and I wish they weren't lump sum investments. She's put money in the Birla Sun Life Equity Fund, iProve Focus Blue Chip, and iProve Value Discovery. These are really good funds, Narendra. Would you like her to convert them into SIPs and perhaps add them to her list and continue SIPs in these funds?
ICICI Prudential Value Discovery Fund is a very impressive fund. It's just the kind of fund, a low maintenance fund for a full market cycle. It gets you a full market exposure and a long enough track record where it has been very impressive. So this is a kind of mainstream fund which should dominate your portfolio, which should be a substantial part of your portfolio. So retain this fund and start your SIP here.
All right, so this is it. This is the list that Narendra thinks you should continue in your portfolio, and only through SIPs. Remember, don't put any lump sum investments into these funds. So this is the fund this is the list that we're recommending to you that you use right now. And if you have any more questions, feel free to get back in touch with us. In fact, Narendra, one last question before we let you go. Amit Gupta has written in, he'd like to invest 5 lakh rupees in a liquid fund. He says, should I invest in 2 or 3 funds or choose a single fund? And do I need to have a demat account to use a liquid fund?
No, one liquid fund is enough, because liquid funds operate in a very narrow range, in a sense, even in terms of performance, as well as the way they are managed. Liquid funds are mandated not to have a maturity going beyond 45 days, so they are unlikely to go in any other direction. Unlike equity fund, where different fund managers can behave very differently, the portfolios can be two portfolios can be completely different. As compared to that, the character of a liquid fund is likely to remain the same. Listing 3-4 liquid funds, I would say Taurus Liquid, Franklin's Treasury Management Account, or Principal's Cash Management Account, or the Birla Cash Plus. They seem more impressive than in a large universe. But I would like to sound you that liquid funds, the best fund, and the average fund, the difference in return may not be very meaningful.
All right, so there isn't too much of a difference between one liquid fund and the other, but if you still want to be very, very specific, Narendra has taken the trouble to pick out a couple of funds for you. Those names are on your screen. If you need any more help, you know how to get in touch with us. Narendra, thank you so much for joining us this week and answering our questions. I know the questions are going to continue to flood in, so we'll see you back again here next week. Welcome back. You're watching Investors Guide on ET Now. It's time for us to take up all of the tax questions you sent in. So we've asked Suresh Surana to come in and answer your questions. Suresh, it's a pleasure to have you back on the show.
Thank you very much.
Our first question comes in from Saurabh Mishra. He's 30 years old. He tells us he recently took a joint home loan with his wife. Now, they're both working. They both want to be able to claim the tax rebate, and they both really should. He wants to understand how that can be done. Suresh, is it important for them both to be co-owners of the home? He wants to know also, is it important for both of them to pay the EMIs jointly out of their accounts? If one of them is paying the EMI and the other one is not, are they still entitled to the tax benefit? Normally, the standard advice that's given to most couples is to start a joint bank account that you both hold and move the EMI out of that bank account. Is that the solution for these two guys as well? What would you recommend?
So, Mr. Saurabh, it is possible for both you and your wife to claim the deductions. So one is, for the repayment of the housing loan up to rupees 1.5 lakhs under section 80C, each one of you can claim the deduction. And for the interest on the housing loan up to rupees 2 lakhs, again each one of you can claim the deduction. But the conditions are that you should be the joint owner of the house, as well as the repayment of the EMI should be done by both of you. It is not enough that only one of you pays. It is not necessary to have a joint bank account. Even if you have individual bank accounts, as long as you both make payment of your share of EMI, that will be good enough.
Atul Chaturvedi has also written in, he recently changed jobs and withdrew his Provident Fund. He says, is the whole withdrawable amount taxable? Is there any way to save tax on that PF withdrawal? Now, Atul, normally you're allowed to withdraw after 5 years, but from your email, I understand that you've only spent 4.5 years with that employer. That would also depend on the trust that's managing your PF. So let's ask Suresh for some advice.
Yes, so any amount which is the accumulated balance from the recognized provident fund, which is withdrawn by the person, it will not be taxable if there is a 5 years of continuous service, with the employer. Now, in this case, apparently you have done 4.5 years. Now, if you have worked earlier with another employer where also you were participating in the provident fund, and then that balance got transferred to this your immediately preceding employer, that period also will be counted. So in the period of continuous employment, they are counting not only the immediate employer but any previous employer where you were participating in the provident fund and that balance got transferred. In case that is not the case, in case you haven't done that, then whatever is the contribution made by your employer along with interest will be taxable as salary in your case, and whatever is your contribution, to the extent of 80C deduction what you have claimed will be taxable, and interest on your contribution will be taxable as income from other sources. The only exception to this rule is that if it is on account of ill health or on account of in case your employer has ceased to be in business and then you get the money, in that case it is not taxable, otherwise it will be taxable. In fact, in this budget now 2015 has now put an obligation on the Provident Fund authority to actually deduct the tax at source at the rate of 10% while making payment to you. So I think it is going to be taxable unless you fulfill these other conditions which I spoke about.
All right, that's a wrap on Investors Guide. Suresh, thank you so much for answering our questions. It's been a pleasure to have you on the show. Remember, we have Suresh to answer your tax questions. We have experts for every area of your money. All you have to do is get in touch. You can reach me personally on Twitter as well. Thank you so much for watching.